The S&P wrapped its worst week in 2 months, so where do we go from here? The Chartmaster says he's still a seller. Let's bring in Carter Worth of Worth Charting. No, it's not. It's a trash business. Sorry about
FedEx.
Carter, back over to you.
I get charter, but I've never gotten carting, but it's all good. Let's figure this out together. Carting can be a good business. Charting can be a good business, too. So anyway, what we have here is the S&P, and the sort of the happy thing is it has lent itself to technicals beautifully, right? We know that on the way up, it has failed at the trend line over and over and over, and on the way down, it's done the same thing. And in fact, down here, it's done the same thing. So it's not DCF, and it's not PEG ratio, and it's not enterprise value. EBITDA is simply and only charts. I know people don't like to hear that, but that is the reality. And what do? We just broke down. All right, let's go forward and let's see what the next one looks like. And what we're going to try to do is drill down on this moment. So we have this very precise minor uptrend line we have broken. And of course, if you were to look at this formation, we have all the elements of that minor head and shoulders top. Really, ultimately, I think we complete this and we get down to the low of 36.36. That is June 16th. That's about 5-6%, and you can see that on the next chart. Now, the real question is, and Grasso raised this, do we go lower? There's every possibility of going lower. Let's look at a final chart and figure it out together. This is all data from the 09 low. So if you simply connect your financial crisis low with your COVID low, we've lived this entire channel until we blew out through the top when the excesses of last year. And now we're simply at the middle point. Do we get down into here? Do we get down into the middle or lower part of the bottom? And I think we do. So 3,300 is about where that comes into play, and why not?
But, Carter, how about the overshoot? Michael Hartnett from Bank of America Merrill Lynch out there today, a guy I respect. And he actually talked about the 35th anniversary of the 87 crash and actually a couple key data points he's looking at that could take you really to 3,000 or 3020 on the S&P. Could that be an overshoot? And, again, just the realm here.
You know, so absolutely. If you look at that last chart, what you can do is just as we overshot through the top of the channel right here, you can overshoot to the downside. But before we get to 32 or 3,000, I think 33. And then I'll tell you, some very big clients talking mid to low 2,000s.
Wow, mid to low 2000s. All right, thanks a lot, Carter.
There's going to be a lot of carting around at that point.
Yeah, it's going to be a lot of. I might have to get into carting. All right, thanks, Carter. We're going to see you back here in a few minutes for options action. All right, let's just trade this. Jeff, again, I see out the corner of my eye, you made a face there when we got to those key technical levels. Was there something that caught you?
I'm always making faces.
Are you always making faces?
Yeah, half the time they don't mean anything. But
what happens if that's just his face? Now you made him feel self-conscious.
Exactly. No, but I mean, those levels are something that we've all been looking at, right? It was that minor upward trend line, and then 3,900 closed below it. So problematic. But we're being so negative. Let me just a little bit of sunshine here on a Friday.
Please.
So, and this is practical advice in dealing with real investment committees. I chair an investment committee for a nonprofit. We're talking about putting cash to work. You are far more likely to regret putting cash to work when the market is up 20% versus down 20% if you have more than a couple of year time horizon. So just keep that in mind. Of course, the market can continue to drop. I think it actually will, but it doesn't mean that putting money to work now is the wrong decision for the vast majority of investors watching this show.
I mean, on average, the markets move up 10% annually since the beginning of markets. But the truth is, I'm negative for the next 2 months. I think that midterm elections are going to be the catalyst for the market to rally in the last 2 months of the year. But I do think we could see some of these much lower levels that really tests everyone's moral fiber.
All right, so really quick, Tim, I'm going to get over to you, but you're saying they're going to rally. So you're forecasting gridlock. Generally, gridlock creates that rally.
Gridlock in the last 2 months, but I think the next 2 months are going to be a little bit tense, and we could see that 3,300 level on the S&P.
I go back to where positioning is and also where you actually see sentiment right now. It's terrible. And you look at consumer confidence. We had the University of Michigan out there today. It's slightly better than expected, but still well below those COVID lows on the University of Michigan confidence. So I just think that the market is prepared on some level. I think this move has been seemingly almost in slow motion when you consider all the things that we've been assessing over the last 18 months. I think you have to be patient as an investor. This isn't going to happen overnight. And in fact, I think you've been given enormous trading opportunities. You've had 9 or more plus or minus 8% moves in the S&P this year. And I think you're going to continue to get those. And again, we've had a major pullback. I think we are, as Jeff said, in a place where there are stories to be bought out there. There are companies we're going to give you in a little bit. There are also ones that I think you can sleep on. But it is time to be finding the best companies in the world. I can own Google here. I can own Apple here. I choose not to be. But I think there's a place where a lot of investors want to know what they can start adding.
Right. I think that might be true in tech generally. Tech, obviously, a moment of capitulation. A lot of those big tech companies, we talk about cloud. We're talking about software names down 50%, 80% from their high. Are those the kind of groups you're talking about that all of a sudden they're not as expensive, they get a little bit more attractive?
Well, look, we talked about this yesterday when we talked about Adobe. Software companies, I think, continue to be a place where the multiples are tough to justify. But when you look at companies that are both have some cyclicality and are kind of hitting some of those headwinds, but we haven't heard the pullback in cloud. That's the one thing that I'd be most worried about with Microsoft and Google, who have a lot of exposure there. But again, Google at 17, 18 times with a PEG ratio kind of 1 or less. That's a company that's priced pretty attractively here, and I think you can own it.